Hello, NAFA Universe. This is Avinash. I'm the equity research analyst here at NAFA, and I'll be taking you over the recently completed Q2 FY26 earnings highlights. Every quarter tells a story. Some quarter whispers, some drag their feet. But Q2 of FY26 spoke very clearly. The Indian companies are learning not just to survive volatility, but grow through it. Nifty 500 this quarter grew at a staggering double-digit earnings growth. This is the third consecutive quarter of such high growth reported by the top 500 companies listed in the Indian universe. They have recorded an earnings of 3.95 trillion rupees, a 15.4% year-over-year growth, and a revenue growth of 6.5% year-over-year. This was achieved despite tariff fluctuations, geopolitical uncertainties, and severe headwinds caused due to one of the most disruptive monsoon seasons. And yet, this quarter finally brought some green shoots. Let's start with what we heard consistently across corporate earnings calls. Rural demand is said to be reviving back, and it seems to be a real catalyst puller for us, supported by the recent GST rollouts and of GST cutbacks form part of the GST 2.0. These are reviving demand momentum and reinforcing consumer trends like premiumization and evolving spending behavior. Perhaps the most encouraging shift came from rural India. After several sluggish quarters, rural demand is finally showing signs of life. Auto companies, PSU banks, and FMCG firms all share the same view that rural demand is slowly showing signs of revival happening. The rural engine is slowly but surely switching back on. Of course, the next 2 quarters will determine whether this is a single-time fad or a trend that will continue to go forward. We're all seeing companies diversify their export exposure from US to other countries in Europe, Australia, and to even multiple parts of Africa. The capacity utilization of manufacturing companies is also reaching higher across a range of sectors. If this continues, it could finally trigger the private capex cycle that has been put on hold for the last 2 years. Now let's move into sector highlights. That's where the real game happens. With strong festive demand and soaring gold prices, many gold companies have recorded stellar profits and revenue growth. The three main performers, Kalyan, Titan, and Senco Gold, have all reported revenue growth of 15 to 20% year over year. All these leaders saw EBITDA margin expansion of 40 to 120 bips, backed by disciplined inventory management, operating leverage, and a push towards high-margin studded jewelry. Simply put, the sector didn't shine but just sparkled. Moving on, we have autos. On the broader consumption front, auto OEMs enjoyed a stronger revival in consumer demand. GST 2.2 significantly improved affordability and supported volume growth. Export markets also added fuel to the fire, with Africa, Latin America, and parts of Europe also seeing increased export from the Indian OEMs, showing strong momentum and stable demand patterns. The next interesting sector that we have over here is the transformer sector. The transformer sector had a standout quarter this time, with most core players delivering 20 to 40% year-on-year revenue growth, with visible margin expansion happening across the board. But what really matters is why those kind of changes happen. This wasn't a cyclical bump, unlike other players in other sectors. This was more of a structural move towards the higher value offerings. Growth is being driven by the 220 kV plus and HVDC solutions, GIS systems, and other strong export-heavy portfolios. This signals a shift from commoditized distribution products to more complex, heavy projects. That's what the Indian market and the global players demand. And with 2 to 3 years of order book visibilities, companies in this particular sector are now expanding capacity and clearing bottlenecks to capture the next wave of demand. All this is being reflected in the strong growth shown in the transformers sector. Moving on to the final sector, we have banks. So banks delivered a steady and reassuring quarter. Growth in net interest income and profitability was supported by improving asset quality and lower slippages. What stood out this time was the PSU banks has outperformed the private sector banks, benefiting from higher operating leverage and cleaner balance sheets. Looking ahead, the second half of the year is expected to be stronger, with NIMs likely being bottomed out and poised for growth going forward in Q3 onwards. This is on the assumption that RBI doesn't impose any further rate cuts. Finally, we have the textiles and the apparel sector, which was more of a lackluster performer due to domestic growth being strong but export demand being subdued due to the ongoing issues with tariffs and other geopolitical concerns happening. On the export front, export focused firms continue to face hurdles from global trade uncertainties and the lingering impact of US tariffs, which kept performance uneven across the board. That said, there were clear pockets of strength. A few export oriented firms did outperform the broader export environment by leveraging a diversified manufacturing footprint across multiple geographies. From a profitability standpoint, the picture was more encouraging. Gross margins across the board improved due to lowering raw material, which is their cotton, supported by softer cotton prices, and a more favorable product mix. For many players, this helped cushion the impact of external challenges and provided some breathing space for the coming quarters. When we put all these signals together, we can form what's ahead for us in H2 of FY26 and for FY27 as a whole. We have festive demand, which was strong, GST benefits, which are rolling out for us, capex sentiment is improving, and corporate balance sheets are healthier than ever. It increasingly feels like the earnings cycle has bottomed and companies expect growth to accelerate meaningfully in the second half of FY26. Let me end with this thought. We believe the second half of FY26 is not just a rebound, but it's going to be a turning point, a moment where sentiments shifts, capacity expands, and industries transition from consolidation to growth. If all these trends sustain, FY27 could be the year when Indian earnings fire on all cylinders and the next multi-year growth cycle begins. Thank you.